Despite weaker than expected industrial data out of China today, our next guest says that there are big opportunities in that country for foreign investors, in particular, because they will soon have greater access to the country's mainland equity market. Steve Sjuggerud is a research analyst at Stansberry and Associates Investment Research and joins us now from New York. Steve, good to have you with us today. Thanks for joining us.
Yep, thanks for having me, Catherine.
Steve, let's talk a little bit about this, the China equity market first. In terms of that market actually opening up, what's the current state of affairs there for foreign investors, and what will change?
Right, so in about a month's time, foreign investors will be able to buy local A shares in China. Now, the A shares currently are just for local Chinese investors, so you or I couldn't go and buy Chinese A shares right now. But what we have is the A-share market is actually an incredible market. It's incredibly volatile. In the last decade, it's gone up by over 100% twice, with a 600% move from 2006 to 2007. But now it's down by about 60% from its highs. So the Chinese government actually wants to do things to help individual investors, to help foreigners be able to buy into the market, to help prop it up.
Steve, I mean, it is so volatile, and a lot of investors who might want to invest in China would rather own the H shares. I know this might be confusing if this is new to some people, but because there's so much volatility and quite frankly, probably risk associated with owning mainland China equities, why is this an okay thing for some of our viewers?
Well, let me back up and explain the lens that I look at the world through. What I do, and I've done this for 20 years, and it doesn't matter if it's commodities, corn, wheat, Brazil, the euro, whatever. What I want to see is assets that are cheap and hated and just in the start of an uptrend. And that's exactly what we're seeing in China right now. We've all seen the TV shows of the shopping malls that are empty, and we know that China's industrial production is falling. And all of the negative news is currently priced in, and the Chinese stocks are trading around 8 times forward earnings. They are cheap and they are hated. But this little bit of news about China wanting to prop up the stock market, and they're doing it in a variety of ways, whether it's a PR campaign in the media trying to get people to buy them, or they're opening up the market to where you could trade between China and Hong Kong. The Chinese government is doing a lot of things to push the stock market starting right about now. So ideally, we'd like to get in before the rest of the world figures this out and starts piling in a month from now.
Very interesting. What kind of vehicle can one use to get into that market?
Yeah, there is. Fortunately, Deutsche Bank came out with a very interesting ETF. The symbol is ASHR, like A share. And it actually is a physical way for you and me as foreigners to be able to own the A share market. So I believe we have dramatic upside. As we did talk about the volatility. It is risky, it is volatile, but I do believe there is actually triple-digit upside potential in the A-share market. And this is exactly the moment you want to see, where it is cheap, it is hated, and we just have a real uptrend in place now in China.
Very interesting. Steve, let's shift it back here to North America. And of course, one item that the world is watching is what the Fed will do as it relates to when will quantitative easing actually end. And by that, I really do mean raising rates. What's your view, and how does this impact all of us?
Yeah, that's a great question. I think it's a very important idea. It's on the mind of most of the people I talk with. What happens when the Fed raises rates? We see mortgage rates going up, and could house prices fall? We see the ability for companies to borrow going up, and so maybe their returns would shrink. But the historical record, our research shows that over the last 30 years, when the Fed has raised rates, extraordinary things have happened. Actually, in all of the previous Fed hiking cycles over the last 30 years, the stock market has actually gone up. And also, the U.S. real estate market, residential real estate, has performed its best when the Fed has been hiking rates. And surprisingly, gold as well has performed its best when the Fed is hiking rates. It seems counterintuitive, but that's what the research shows. And so I really want to get that message out. I'm actually bullish on stocks right now. I think there's still room to run in the stock market even after the Fed starts raising rates.
Steve, I want to ask you, though, I read something, and I believe you said that that with the Bernanke stimulus program that was put in place a number of years ago now, that asset bubbles are being created. We talk about that a lot at BNN and on BNN, but nobody knows really what that will look like when those bubbles burst. Do you have a view?
I do. I do. I have a strong opinion on this. I heard a previous guest say, well, valuations are getting stretched a bit. But this is what happens in bubbles, is that valuations do get stretched. And you have to keep in mind that interest rates are near record lows right now. So I believe that valuations can still get much higher. But value actually is never the sign of the peak of a bull market. I think what you see when you see the peak of a bull market is like we saw in the dot-coms in '99 or in real estate in 2006, where people said you can't lose money in real estate, you can't lose money in stocks. When the individual investor fully believes in these assets, that's when you're near the peak. And right now, I think everybody's concerned. I don't think there's as much optimism in stocks yet that you would need to see a peak. And most importantly, the biggest gains come in those final innings of the stock market bubbles. So you don't want to miss out, just like the real estate in 2006 or in the NASDAQ in 1999. You don't want to miss out. You want to stay on board as long as you can.
Steve, I hear you as it relates to the equity market, but what do you think people will not be expecting? And by that, I mean, do you think that inflation will rise, interest rates will rise much faster than expected? You know, what are some of the things that people aren't even talking about that we should be?
Well, I think that one of the areas that I'm personally most excited about is actually U.S. residential real estate. And people are not thinking about the fact that we had the greatest fall in residential real estate prices in generations, and we have record low mortgage rates, you know, the lowest mortgage rates ever seen over the last 2 years, and it's not much higher today. So residential real estate is an incredible value in America. And there's still plenty of upside, in my opinion, there. It's what I've been doing with my own money. And I just think that people don't have any clue how cheap it really is right now. So I think the biggest surprise will be we will see yet another potential real estate bubble in America.
Steve, we'll have to leave it there. Great to have you on the program today. Thank you so much.
Thanks for having me, Catherine.
Thank you. That was Steve Sjuggerud. He's a research analyst at Stansberry Investment Research.